Welcome to the NISM Masterclass. I am your host, Sashi Krishan. Today I am speaking to Mukesh Agarwal, the Managing Director of NSE Indices Limited and NSE Data and Analytics Limited. Mukesh is a business leader with 3 decades of experience in the financial service business. He has spent 10 years with the National Stock Exchange, and prior to this, he spent 2 decades with CRISIL and was their president of their India research business. But what also excites me is that Mukesh and I share the same alma mater. We are both from the Birla Institute of Technology and Science, Pilani, though I was Mukesh's senior by almost 10 years. Welcome to the NISM Masterclass, Mukesh.
Thank you, Sashi. Thank you. It's my pleasure to be here with you on this today.
So, Mukesh, let me begin with a very fundamental question. What purpose does a securities market index perform? I mean, does it in any way reflect the overall financial health or the economic health of a country, or is it just a reflection of, say, corporate performance, investor sentiment, liquidity in the market, those kind of things?
So if you look at an index, basically the basic function of an index is to give an indication about the performance of a basket of securities. So what do you mean by basket of securities? Basket of securities could be, let's say, set of equities, stocks, or it could be debt, bond markets, or it could be commodities markets, gold, silver, etc.
Right.
And within equities also, one is to give an overall performance outlook of the markets. Like if you look at indices like Nifty 50, Nifty 100, Sensex, or Nifty 150 mid cap,
right,
they give you broad indication about the markets.
Right.
Then you also have sectoral indices. If
Right.
you have a Nifty Bank, Nifty IT,
right,
so they give you an indication about the performance of the respective sectors.
Right.
Similarly, in the bond markets,
Right.
bond market indices are slightly complicated.
Right.
Why I say complicated? Because bond market, there is a three-dimensional thing. One is tenure. Second is asset class.
Right.
Asset class is basically, it could be government securities, corporate bonds, CP, CDs,
Sure.
SDLs. And third is ratings. It's a three-dimensional.
Right.
So basically, you can create indices for the bond markets using one of these three features, different features, mix and match. And they will give you an indication about that asset class, what kind of returns those asset classes are giving you. Similarly, now you can also create indices of commodities, gold, silver, mix and match, and they give you an indication about the performance of those asset classes.
Right.
So what I want to say is indices talk about the performance of a respective basket of securities. It could be of different things. And economy is kind of a surrogate. It's not directly an indication of the economy. Why do I say that? If you look at Nifty 50, which is the flagship index of NSE, so the highest weightage is given to around, highest weightage is of financial services sector, which is around 33%.
Right.
Next is IT around 13%, and then it is energy around 12.5%. And if you look at the composition of Indian GDP,
Right.
I think when I look at the data some time back, so financial services account only for 20% of GDP.
Okay.
And other thing, if you look at, all of us know that SMEs play a very important role. They account almost for 30 to 35% of GDP. And number of SMEs listed on the stock exchange is very, very limited.
Right.
Similarly, a lot of these new age companies which are coming in, not many of those companies are listed on the exchanges.
Correct.
Accordingly, it doesn't reflect directly because the companies listed on the exchange could be very different. The composition of those companies could be very different.
Right.
So otherwise, I will not say that it talks about the performance of the GDP, indication of the GDP. It's more of talking about the indication of the financial performance of the markets, which in turn is reflection of the performance of the GDP. That's what I would say.
Right. So, if I understand this right, Mukesh, you are saying that the index primarily represents publicly listed companies, and there is a whole section of the economy that is, unlisted, small scale, startups, those kind of guys.
Correct.
So, if you really wanted to get a sense of how are they performing, then how would you do that if you did not have an index that represents them?
So typically, it's a very good question. So basically, if you look at it, as I mentioned, typically those companies will be dependent on the large companies. If you look at like Nifty 50, again, I'll come back. For Nifty 50, it talks about, it accounts for almost, it has top 50 stocks listed on NSE.
Right.
So how those companies are performing, how those companies are doing, that will be indirectly impact the smaller companies because they also have an association with them.
Right.
So indirectly, it gives an indication about them also. Otherwise, what we have also done is, if you know NSE, we have a platform for SME listing called NSE Emerge.
Right.
And so we have also created an index for the companies listed on the Emerge platform. So it gives an indication about the SME companies which are listed on the stock exchange. And what we also do is Nifty 50 I've spoken about, but we also have an index. The broader index is Nifty 500, which comprises of 500 stocks listed on top 500 stocks listed on NSE.
Right.
So that gives a good indication about the economy and the GDP, etc. So that is how what.
Right. So I think given that there are forward and backward linkages in the economy, the index in any way is a surrogate to the overall
GDP.
performance of the corporate sector.
Yeah.
So let's get to the Nifty 50 because I think this was launched in 1996 and today it is an index which nearly every investor and not only investor, every citizen of this country now is very familiar with, right? And as a market gauge of the largest and most liquid companies, most people are familiar with the Nifty 50, the name, but not too many people are familiar with the details. I mean, if you do go and ask a man on the street as to what are the details of the Nifty 50, he may not know. How are the companies that are there on the Nifty 50 chosen? How is it constructed? How is that universe arrived at? What is the weighting that you have for the different companies? So could you just give us a quick brief on how do you construct, say, an index like the Nifty 50?
Okay. So if you look at Nifty 50, the name itself indicates that there's got 50 stocks.
Correct.
So Nifty 50 includes the top 50 stocks listed and traded on National Stock Exchange or NSE. And though that is.
So if I may interrupt, what do you mean by top 50?
Yeah,
If that,
so
that would be useful for us to know.
Top 50 in terms of free float market capitalization. So if you look at any company, we look at two kinds of market capitalization.
Right.
One is full market capitalization, which
Right.
is basically the total outstanding shares into the market value. That is
Right.
full market capitalization.
Right.
But for indexing purposes, typically we use free float market cap. So what we do is in the full market cap, we adjust for, let's say, the promoter's holding or any strategic investor or any shares which have a lock-in. So basically we try to include only those stocks which are freely available for trade or likely to be traded. So that we take as a free float market cap. So basically that is what Nifty 50 includes, top 50 stocks in terms of free float market cap. And I would say like Nifty 50, the way we call it, it is a stock of the nation. And it's a barometer of the Indian capital markets. So anyone who wants to track Indian capital markets, as you also said, they look at the performance of Nifty 50. Now, Nifty 50, if you look at it, of all the stocks listed on NSE, it accounts for approximately 47% of the market cap of all the stocks listed on NSE. It accounts for 57% of the market cap of all the stocks listed in the free float market cap of all the stocks listed in NSE. So 47% of the full market cap, 57% of the free float market cap, and the 50 stocks which are there in Nifty 50, as when we look at the last numbers, they account for around 28 to 29% of the total trading volumes of NSE. So that is a good representation of that.
Right.
Now you said, how do we select the stocks?
Right.
So basically what we do, we look at the top 50 stocks in terms of free float market cap, and the composition is not static. We do a rebalancing once every 6 months. So we do a rebalancing in February and in August. The February one gets implemented from last trading day of March, and the one which we announce in August gets implemented from last trading day of September.
Right.
Now, what is the criteria for a stock to get into Nifty 50?
Right.
The broad criteria, one is it should have an FNO available on that stock. Second is it should be traded.
FNO is futures and options.
FNO is futures and options.
Right.
And then second is it should be traded on all days in the last 6 months, and the stock should have been listed on the stock exchange for at least for 1 month prior to when we do the rebalancing.
Okay.
And also we look at the impact cost, because we want to have stocks which are liquid and which can be replicated by markets or by the investors. So we also look at the impact cost. Impact cost should be less than 0.5% of the portfolio of a size of around rupees 10 crores. And also for a stock to come in and to replace an existing stock, the free float market cap of the stock which is coming in has to be 1.5 times of the stock which is going out. So let me just take an example. Let's say the free float market cap of the 50th stock, the smallest stock in Nifty 50 is, let's say, 10,000 crores for simplicity purposes. And the new stock, when we are doing the rebalancing, if it has to come into the index, the free float market cap of that stock should be minimum of 15,000 crores.
Okay.
That is 1.5 times of the smallest stock which will go out. So we
Right.
look at this criteria. Based on that, we do the rebalancing. And if you look at Nifty 50, it has got around 13 sectors. The largest weightage is with the financial services. It is around 33%. Next is IT. IT is around 13%. Third is energy. Energy is around 12.6, 12.7%. Good thing is the composition, as you said, Nifty 50 has been there since 96, 95. So composition of the sectoral composition of the index also has been evolving. So when we launched the index in 1995, financial services has a weightage only of 20%.
Okay.
And if you look at FMCG had a very high weight, then your IT had no weightage because all of us know that the listing of IT companies had just started in 95 and they were very small. So IT had no weightage in Nifty 50. Then your manufacturing had a large weightage, FMCG had a large weightage, oil and gas had a large weightage. Today, if you look at manufacturing sector, metals had almost 10.9%. Now, because of the evolving nature of the economy, changing composition of GDPs, from financial services sector, which was 20% in 1995, had gone down to 12.5 or 13% in 2005. Now it has got around 33% weightage.
Okay.
IT sector, which had zero weightage in 1995 because sector was very small, had around 20% in 2005 because in that time IT companies were booming. So weightage had increased to 20%, and in now currently it's come down to 13%. Metals, when we launched it, had 10.9%. Now it is around 3.5 to 4%. So what we are trying to say that is, as the economy evolves, as the sectors contributing to the GDP, they change, the market caps change, the composition of the index also changes.
Okay. So, I mean, what you do seem to be telling us is that it ultimately reflects the evolving nature of businesses in the Indian economy.
Correct. Yeah.
Okay. So, I have a couple of more questions.
Before that, I can go to add a few things on Nifty 50. See, Nifty 50, because ultimately, one is people invest. We will definitely talk about more about passive. So Nifty 50 is an index, so we look at the returns, what kind of returns the index has given. And I will talk about total return index. So let me just also clarify. There are, when you look at the index, returns of an index, we look at two kinds of returns. One is price return and second is total returns.
Right.
The index, what we see every day, and the people talk about the returns, that is the price return.
Right.
So that is a difference in point-to-point difference in value of the index and what is the kind of returns you have generated. So what we do in total returns, because if you're invested in the index, companies give you dividends. So we also reinvest the dividend into the index and then we look at the returns. Right. Typically the dividend returns on an average has been around 1 to 1.25%. So total return index gives approximately 1 to 2.5% higher than the price return index.
Right.
So if you look at the total return index of this Nifty 50, and we started calculating total returns around 25 years back.
Right.
And so total returns since inception has been around...
That's since 1996.
1999, 25 years approximately. Right. So the total returns of this Nifty 50, return of total return index has been around 15%, 14 to 15%.
CAGR.
CAGR, yeah. Compounded annual growth rate returns, annualized growth rates have been around 15%. Similarly, 10-year returns have been around 14 to 15%. Mm-hmm. Good thing is, when we look at the daily rolling returns over an investment horizon of 10 years, 7 years. So what I mean by that, today you look at 10 years back, what is the return today? So
right.
Then tomorrow we will look at 10-year return tomorrow from 10 year back.
Right.
Then we look at it 3 years.
Right.
So if you look at 10-year and 7-year investment horizons and daily rolling returns, Nifty 50 has never given negative returns.
Okay.
So 100% of the times, the returns have been very positive. So as all of us hear that when you are investing in equity markets, you invest from long-term perspective.
Right.
And this data also substantiates that, like Nifty 50 has never given negative returns if your investment horizon has been 7 years or 10 years on a daily rolling return basis. So that is one. And second thing is, they have not given negative return. And second is, 80% plus of the times, the returns have been 10% and above. Okay. So that is around 40% times the returns would have been 15% and above, and another 40% times the returns would have been 10 to 15%. And even if you have an investment horizon of 5 years, it has given negative returns only on 0.1% instance. Even in 5-year investment horizon, the returns have been positive in 99.9% times. So I think that talks about the returns. And so I think that's what I want to talk about.
So in short, if you look at the total returns that anybody would have got if he had invested in the index, so if he had remained invested for the long term, he would never have got a negative return from this market.
Yeah.
And two, if he had remained invested for the last 25 years, he would have got a approximate 15% CAGR over this last 25 years, which is better than any other instrument that is available today in the market.
Correct.
Talking about index constructions, I just wanted to ask you a couple of questions on the methodology, for clarification. One is, you talked about free float, and you said that you use a market cap, free float kind of methodology. But you also have different other weightings, like you have price weightings, for example, you have equal weightings, you have custom weightings. There are multiple methodologies. Now, which is the best way and how do you understand these different weightings? That was the first question on this methodology, which I wanted to ask you. The second, you said you keep rebalancing. Now, the idea is that you also mentioned the frequency, but there must be certain rules that you have for this rebalancing. And I just wanted to understand that, how do you ensure transparency in this process of rebalancing? Because, it shouldn't, how does a person who's investing into the index know that there are a set of rules that have been followed in this rebalancing? And then a last question. See, how do you actually ensure that the index is meeting its objective? If the index is supposed to be measuring the sort of performance of a particular sector or a particular market cap category, how do you know, or how do you measure whether it is still relevant, whether it is still accurate? So just three questions in terms of that methodology from what you told us a few minutes back.
So basically, if you look at any index,
Right.
We take a lot of pride in saying that any index is always rule-based.
Right.
Its rules are very objective, very transparent. They are non-discretionary, and rules are always available in public domain. So today, if you look at it, Nifty 50 or any other index, how do we construct, how do we do the rebalancing? All the documents are available in public domain.
Okay.
It is so transparent that people know that we are going to announce the rebalancing in the month of August. 15, 20 days before that, people start making their own speculations and guesses what will go in and what will go out. So I think that is the kind of.
So why should it be speculation? Because the rules are there, then anybody can sort of.
There are certain things, there might not be any exact data, what data we use and all those kind of stuff.
Right.
But it's actually, as I said,
broadly most of the data is available.
Objective, transparent, non-discretionary,
Right.
and no one can influence it. It's totally objective. I think that is the good thing about the indices.
Right.
Now, coming to the weightages, how the weightages are assigned, I think that is a very valid question. So the four different kinds of 4 or 5 different methods are there. One is we use free float market cap. I'll also explain it with an example.
Right.
Or full market cap.
Right.
Then we also have something called equal weight.
Right.
And then we have price weight.
Right.
So price weighted indices are very, very few. That is not supposed to consider to be a very efficient methodology of weighing. Like today you have Dow Jones Index or Nikkei 225. Those are price weighted indices.
And they're very popular indices.
Very popular.
Also, no?
Very popular. But most popular way of weighing is free float market cap. For our Nifty 50 and others also broad based indices we use.
So would you say the Nifty 50 is superior to the Dow Jones?
I will not compare that. I will never get into that comparison. But I would say that most of the popular indices, otherwise if you look at S&P 500, MSCI and other indices in India, Sensex and all also, the weightages is given using the free float market cap. But I think for the listeners' benefit, let me also simplify what do I mean by free float market cap weightages and full market cap weightages.
That will be useful.
So let's take two stocks. Let's say the two stocks, one stock, the full market cap is 100.
Right.
Other one is 200.
Right.
I'm just taking there are two stocks in the index.
Right.
Now when we calculate the weightage based on the full market cap, 100 and 200 total is 300.
Right.
The weight of the first stock will be 100 by 300, basically 33%.
Correct.
And the weight of the second stock will be 200 by 300, which means 66%.
Right.
That is in simple terms.
Right.
Similarly, what we will do is for free float weighted, we don't look at the full market cap. We look at the free float.
Right.
Let's say 100 and 200, the free float market cap in first case is 60. And in next case, it is 140.
Right.
So 60 plus 140 becomes 200.
Right.
The weightage of the first stock will be 60 by 200, which is 30%. Weightage of the second stock will be 140 by 200, which is 70%.
Right.
This is what we use.
Right.
So free float market cap is the most popular way of doing it, and there's a logic for it.
Okay.
The logic for it today, see, basically, I think I'll go back one step back. What are the indices used for? there are two things indices are used for mainly. There are many other uses, but two main uses, or three, four uses. One is people use the indices to compare the performance of their portfolio vis-a-vis the market.
Correct.
Because I, as an investor, if I'm invested in, I have my own portfolio, how do I know whether I'm doing good, bad, ugly, or if you have invested in mutual funds, how do you know your mutual fund is performing against the markets?
Correct.
So people use the index as the benchmark to compare the performance.
Correct.
So that is one. Second thing is also something called passive investing, which probably we'll talk about it in later.
Right.
So people use that to construct their portfolio.
Correct.
They can just replicate the portfolio.
Right.
So people use it for that. Third thing is people also use it for trading of derivatives. Today, if you look at it, Nifty 50, Nifty Bank, you have derivatives trading on NSE, you have derivative trading on different indices and BSE. So people also use it, futures and options, basically derivative future options.
Right.
People also use the index for derivatives. And the third will be people also use the indexes for attribution analysis,
Right.
research.
Right.
So basically, if my portfolio has given 5% higher returns as compared to the index, then what has led into that higher returns, whether higher exposure to a particular company or a higher exposure to a particular sector. So all those kind of things, that is they using it for the purposes.
Right.
So sorry, where were we? So
So two fundamental purposes you said. One is benchmarking, and the second is you said passive investing are two of the key things, and then also certain other uses like derivatives and
Correct.
attribution and
Correct.
stuff like that.
So we talked about, then we were talking about the weighing methodology,
Right.
then we talked about free float.
Correct, correct.
And we also have equal weight, wherein all stocks in the index, like Nifty 50 has got 50 stocks, all stocks will have 2% weightages. So I think these are the three ways of doing the
constructing the weightages.
constructing the weightages.
Yeah. So the second question I had was on this rebalancing and how do you ensure transparency in that
so
process?
rebalancing transparency, as I already mentioned earlier, all the index methodology is available in public domain.
Right.
It's objective, transparent, non-discretionary, rule-based, available in public domain. So we have.
So it's just a formula. You put in a formula and you rebalance.
Yeah.
That's about
Yeah,
it.
correct. And we also have a predetermined frequency for each index. So, like if you look at Nifty 50 and broader indices, we do the rebalancing semi-annually.
Yeah.
And if you look at, there are some strategic indices for which we do a rebalancing quarterly.
Okay.
And there are certain indices like we have dividend opportunities funds or value funds. We do the rebalancing once in a year.
Okay.
But the frequency is predetermined. It is already mentioned in our methodology document.
Right.
And if you look at the corporate or the bond indices, bond indices frequency is slightly different, or we could have some indices on which we have a higher frequency of rebalancing, like SDL index, State Development Loan Index.
Right.
We have a rebalancing once every week.
Okay.
An index on CP and CDs, commercial papers and certificate of deposits, we have rebalancing once every 15 days, once in a fortnight. Then we have government securities indices, indices comprising of government securities. We do a rebalancing once every month. And if you do an index on corporate bonds, we do a rebalancing every 3 months. So basically, it depends on the asset class, what is the nature of the asset class, and what is the purpose. That helps us in deciding what should be the rebalancing frequency. And also in equity, as I mentioned earlier, people also use the indices for passive investments. So we don't want to rebalance also very frequently, because that will result into churning the portfolio very frequently, and that has got certain costs associated with it for the investors.
So, and then I had that last question, how do you sort of actually determine whether you're meeting your purpose, whether index is still relevant, whether the index is accurate? I'm sure along the way you must have dropped a lot of indices also, saying that they are no longer relevant in this market. So could you just...
I think it's a very valid question. So basically, when we talk about it, any index, basically we follow two principles. One is it should represent the market, and secondly, it should be replicable.
Right.
And so what happens ki the methodology also, what we have assigned initially, they don't remain constant for life. So basically what happens, based on the market feedback, based on the changing market conditions, we keep changing the index rules also.
Right.
So to ensure that it remains relevant and affects the market.
Right.
So today, like if you look at Nifty 50, I just said for stock to come in, the threshold is 1.5 times.
Right.
Earlier, it used to be 2 times.
Right.
The impact cost earlier used to be 1%.
Right.
Now, with the market becoming more liquid, we have reduced it to 0.5%.
Okay.
So that is what we do.
Okay.
Second thing is also like typically, especially in the sectoral indices, because if I am creating an index, let's say banking sector or real estate or a metal sector, so how do we ensure that it represents the market? So what we do is typically we look at the benchmarks, and let's say the total market cap of all the, let's say, banking stocks is, let's say, 100 rupees. The stocks which we are including in the index, we include number of stocks in the index in such a way that they should represent at least 80 to 90% of the market cap of all the listed stocks in that particular segment. I think that is a good representation. And also what we do is we keep taking feedback from the market, and if the market feedback is slightly different or they give us a positive feedback, so we factor that also and we try to make the changes to the index.
So, you were talking about representation, and, I had a question on that because, we do sometimes find certain biases creeping into the index, right? For example, if you look at the Nifty 50, you'd have, 5 stocks that make up 1/3 of the entire index, right? Or similarly, if you look at the sector weightage, you yourself had mentioned that banking sector is now something like, 18-20% of the index. Now, for somebody who wants to either replicate the index or invest, very similar to the index, he could land up taking, excessive exposure to some particular sectors or to some particular stocks, and there could be some such biases that creep in. Is there any way that, investors or fund managers could address this particular issue?
See, first of all, I will not call them it's a biasness. It is a representation of the markets also, right? Because if you look at it, this financial services sector having a large weightage in Nifty 50, there has always been debate in the market, right? And people have been saying, should we cap the weightage of a sector in the index? So what we also
you actually have sector capped indices also?
We do have in some other indices, but this is because these are broad-based indices which represent the performance of the overall markets.
Right.
Here we don't want to put the caps.
Sure.
So if you look at it, when we did a study, then if you look at what is the weightage of banking or financial services sector in the entire listed space of NISM, that itself is more than 32-33%. So if weightage of financial services in Nifty 50 is around 32-33%, that means it represents the markets. Correct. Really, by putting an artificial cap on the weightage of the index, you will be unnecessarily constraining the index.
Right.
So that is one. So I will not say the biasness comes in. So see, as I said, it is totally rule-based, formula-driven, transparent. At times, you might have some some stock which might come in.
Right.
And because we do the rebalancing once in 6 months, so taking action on that particular stock might take some time. I'll give you a classical example of Yes Bank.
Right.
So like Satyam. Right. Satyam was part of Nifty 50 at that point of time, and when it busted, and it was still part of the index, and then we have to immediately remove the stock from the index.
Right.
Similarly, Yes Bank, when the problem happened in, I think, 2020, it was part of the index, and we could see the prices were falling. But we have a fixed rebalancing period, and we do that once in 6 months. So we could not rebalance, we could not take any extraordinary action. But what happened? The moment RBI took action on the stock, immediately we also removed the stock from the index. I think those kind of things could happen. Otherwise, 1 or 2 accidents, I would call them accidents, might happen. Otherwise, I will not say there is any biasness will come in, because it is determined by the markets, and it's the markets who are deciding what should go in and what should come out. Because if the prices go up because of the market interest in the stocks. Right. The market goes up, it will come into the index.
Okay. The other question that I had is that now you have a large number of indices, which actually, becomes a little confusing for the lay investor, because today you have, say, 10 sectoral indices, you were talking about them. Then you have, you have Nifty 50 to, I think, the Nifty micro cap 250, across entire market capitalization. Then you have sectoral indices, you have thematic indices, you have strategy indices, you have fixed income indices. So your volatility indices also nowadays, right? So can you give us some details of these various index categories? Is there really a need for so many indices? Okay. How do you sort of clear the clutter, if I may put it?
So basically, if you look at it, today we have around 100 equity indices.
Right.
And we are launching new indices almost every other day, I would say.
So you're confusing investors?
No, we are not confusing the market. I will not say we are confusing. So I'll give an example. We have launched some very interesting indices. One we launched on EV and new age manufacturing.
Correct, I saw that, yes.
That is the one index which we have launched. Then another index we recently launched was on tourism, India Tourism Index.
And then you had something on ESG also.
We have three indices on ESG also.
Right.
So what I would say is our indices, I said we have around 100 indices. We classify them into 4 broad categories. One is broad-based indices. Broad-based would be Nifty 50.
The market cap.
Market cap, mid cap, small cap. Then we also launched something called micro cap. why we launched microcap also was because
So there were 1,500 stocks that are listed on the exchange.
we have around 2,000 plus.
Say 2,000 stocks listed on the exchange. Then all these 2,000 would be part of some index.
No, it's not that. Then I think I will take another class on how we go about it. Basically, but our index is, our main parent index is Nifty 500,
Right.
which comprises of top 500 stocks.
Right.
Then, based on the market demand, we created an index called Microcap,
Right.
which is the next 250. After 500, next 250. I think
Right.
it stops there.
Stop.
And then we have a total market index, which is Nifty 500 plus Microcap, which is 250, the top
750.
750 stock.
Okay.
So as I mentioned, we categorize and we have 100 indices, 4 broad categories, broad base, I've already spoken about.
Right.
Then we have sectoral,
Right.
all the various sectors, bank, pharma, real
Right.
estate, metals.
So every sector is covered literally?
Every sector which has got good representation.
Has
Say
got
in
good
India, the problem is not many sectors, you have enough number of stocks to create an index.
No, like you said EV. Now, is there enough representation? In
EV actually was a very lot of innovation went into how to create that index and what to include, how to include. Because India today, if you look at it, not many EV stocks are listed.
Correct.
So what we did was we are calling it EV plus new age manufacturing. So we included all the EV manufacturers, then also companies which are supplying technology to this EV companies.
Right.
Then companies which are supplying components to this EV manufacturers.
Okay.
And then also the companies which have got the PLI and other listings done and who have intentions of investments in this particular segment. So we have included those stocks. So we have around 20 stocks in this index.
Okay.
Then we have, as a sectoral, then we have thematic.
Right.
Thematic will be, let's say, India consumption, India manufacturing, India infrastructure, our ESG indices.
Right.
We also have indices on 3 corporate houses like Tata, Mahindras and Birlas. So
Okay.
those will be our thematic indices. And the last one, which is an emerging sector, which is called strategy indices.
Right.
Strategy indices are basically are people have different strategies for investments. I think you know that.
Right.
Basically, some people want to invest only on momentum stocks,
Right.
stocks which have momentum,
Correct.
or stocks which comprise of alpha
Right.
or quality,
Right.
value,
Right.
equal weight. So we have a mix and match of everything. So we
Right.
have these broad categories.
Right.
So I will not say it's a clutter because see what happens if you look at from investors' point of view, one is if different investors have different investment strategies.
Right.
And we as an index provider, we need to ensure that we have indices which meets the requirements of different investor segment. I think that's what I would say. Otherwise, if someone has to look at the markets, as you know, all of us broadly look at Nifty 50 and that gives us a good indication of the markets are performing. But now I as an investor, I want to invest in mid cap. For that, I have to give him a mid cap stock. Similarly, banking sector, if you look at, it is very popular both for derivatives trading and also for passive investments. So we have to give a banking. Now someone wanted, I don't want banking because banking includes both private and public sector. You please give me a private sector. I want to
Right.
invest only in private sector. So we created an index on private bank index. So similarly, like we had a pharma, which only had pharma companies. Someone said, no, I don't want only pharma. I want healthcare because pharma, we don't include hospitals and other diagnostic companies. So we created an index called healthcare index, which had pharma plus healthcare.
Right.
Similarly, we have IT. IT comprises of IT companies. Now someone said, I want digital. Digital, what do we do is, IT companies are there, but companies like Zomato and all who are using technology for delivery or customer to reach out to the customers. So we created that index. I think that is based on demand. So we don't, today to be honest with you, we are so much of flooded with demand. We don't have time to create any index on our own. So we are getting more demand from the market participants. Please give me this particular theme, this particular strategy. And we are creating indices to meet those demands. And last 2-3 years, if you look at whatever new indices which we have launched, one or the other passive product has been launched on those indices.
Yeah. So this is, I think, a good time. You were talking about investors and you know how investors drive a lot of what you do. But you've been a champion of index-based investing. And we've had many conversations in the past where you sort of put forward this idea as to why, you know, index-based investing is superior to active investing without getting into, you know, too many nuances out there. Is it only about the low fees or is there something more to the whole thing than, you know, why, you know, you have been championing index-based investing?
So if you look at, let me come back to that. Let's, I think, spend 2 minutes on what is index-based investing.
Right.
So, or it's called passive investing.
Correct.
So in the markets today, if you look at it, on one side we have active investing, on the other side we have passive investing.
Correct.
So what is active investing? Active investing is basically the fund manager takes a call which
Right.
stocks to invest in.
Right.
And the main idea is to beat the returns of the underlying index.
Right.
If I'm creating a portfolio of large cap, so I will try to actively invest in the stocks so that my performance is or returns are higher than the underlying index, which typically markets use Nifty 100.
Right.
So that is the main thing.
Right.
Now in passive, what people do is in passive, you just replicate the portfolio of the underlying index and with the same weightages, and you don't take any active calls, you blindly follow that, and you're trying to give the returns in line with the returns of the index. I think that is the main difference between active versus passive. Now, there have been global studies which shows that year after year, majority of the funds have not been able to outperform the underlying indices. So like for large caps, people like SEBI prescribed or MP prescribed benchmark is Nifty 100. Are majority of large cap funds able to outperform Nifty 100? No. There will be funds which are outperforming. I am not saying that everyone doesn't outperform. Majority is underperforming and others will be similarly for mid cap and small cap. The other thing what happens is those various studies have shown the top performing
So do we have a percentage out there which says that, global studies over the last 50 years have shown that not more than 10% of the active
As
funds
I said, majority of that means that more than 50% of the funds are not able to outperform.
More than 50%.
Yeah, majority means underlying more than
Right.
50% are not able to outperform.
Right.
The problem for the investor is that means that majority is not able to outperform. So there are still funds which are outperforming.
Correct.
Now the problem is the fund which is outperforming the index.
Right.
And there have been studies which show that it's not the same fund which continuously outperform the index.
Correct.
So today you might have ABC which is outperforming. Tomorrow XYZ will outperform.
Correct.
So I as an investor, how do I ensure that I'm always betting on the winning horse every time?
Right.
I think that is the biggest challenge.
Right.
So to avoid that problem,
Right.
you take an exposure to the passive, and if I'm happy with the market returns, I think that is the basic philosophy. I have to be convinced that I don't want outperformance. I'm happy with the market performance.
Right.
So I will invest in the market. So I think that is the basic thing.
Right.
And second thing is cost is also very low. Typically, passive products, your cost will be 0.03 bips, 0.03% to 0.5%.
Correct.
Whereas on active funds, the returns or the cost could go anywhere in the equity side, could be anywhere from around 0.8, 0.9% in direct to 2.5%. So that itself gives a huge difference if you're looking at a long period.
From a compounding perspective, even the small change in fees will make a big difference to the returns that you get. Mukesh, for an individual investor, investing into a ETF or investing into an index fund could be a great starting point. But how does she make a choice as to whether I should invest into an index fund or I should invest into an ETF?
Okay, so I'll go back more into basics. What is the difference between ETF and index fund? So if you look at ETFs or exchange traded funds, so they are traded on the stock exchange like any other equity share. So for investor to invest in ETFs, he needs to have a broking account, and he or she also needs to have a demat account. So that is one. And on the other side, the index funds you buy directly from the mutual fund, and you don't need to have a demat account. So that is the second thing. Now the benefit of ETF is if you have a demat account and if you have a broking account, you can capitalize on the volatility. Okay. Let's say on a particular day, and we have seen that also, like on June 4th when the elections were there, the ETF trading volume just shot up. Normal volumes in this year has been around 1,400 crores a day. That day, the volumes went up to 4,000 crores. Right. So investors do capitalize. So if I get a good opportunity, the markets are coming down.
So you get a chance to buy or sell during the day.
During the day at that particular market value.
At that market.
So but otherwise what happens in index fund, you buy it directly from the mutual fund. You get end of day NAV net asset value. So you get end of day. So basically, let's say in case of any particular day, opening value was 100 and it came down by 5% to 95 and again went back to 100. Right. The index fund you will get it at 100 only.
Correct.
Whereas in ETF, it came down to 95, you have the opportunity, you can buy at that 95. Correct. I think that is a basic difference. Right. Otherwise, and cost-wise, ETFs are slightly cheaper than index funds. So my advice or my suggestion is if someone has got...
So how much cheaper? You said ETFs are at 3 to 5 basis points.
So like Nifty 50 ETFs are available on 3 bips also. So ETFs will be 3 to 20 bips or whatever it is. And on the index funds, it is around 10 to 50 basis points. The main difference in index funds is why it is higher, because mutual funds have to pay some money to the distributors. So distribution commission is also there. So typically that way the index funds are slightly costlier as compared to ETFs. So if you have an ETF account, trading account, demat account, one should buy for ETFs. But buying ETFs also is a state is an art, because and what happens ki for all the ETFs which are trading, mutual funds also disclose the live NAV, net asset value at that point of time.
Right.
So when an investor is buying, he or she has to ensure that the price at which you are buying is closer to the live NAV or INAV basically.
Right.
I think that is very important. So you have to look at that. Second thing is, in index, you don't have to bother about it. Just place your order, whatever is the end of day NAV, the mutual funds or a lot of the units to you. So that is one. Now, how does one choose which passive fund? Because there is a
No, before that, there's a question that I asked. So, if I needed to do a systematic investment plan, then the index fund is a better option, because in the ETF, there are so many decisions I need to make, right? When to time the market, to look at that live NAV and things like that. But if I just wanted to put in a small amount of money every day or every week or every month, an index fund would be a good option.
I think for I would say the retail investors or the people who are just starting to invest, I would say that way index fund is good.
Right.
Otherwise, today, if you look at it, a lot of brokers, they also offer you SIP in ETFs.
Okay.
So you tell them whether you want to buy XYZ number of units or you want to invest a lump sum amount into XYZ, some particular ETF. So on that day, they will execute your order, and each broker has their own timing at which they will execute the order. But only thing is, then whatever is the market rate, at that you will get the order.
So you could do an SIP through your broker in
ETFs also.
Yeah.
So they are also offering that.
Right. So coming down to this choosing of which fund, because today there are almost 70 equity index funds, and there will be 120 ETFs. So how do you then choose which passive investment vehicle you want
So
to
I
put your
agree
money?
with you. So there are 2-3 things. One is, today, if you look at it, I think July end, there are around 442 passive products available in the country.
442. Okay.
And in equity, there are, I don't remember the breakup between equity and debt, but there are 78 equity indices on which passive products are available.
Right.
78 unique indices, means Nifty
Right.
50, mid cap, and
Correct.
and there are 120 debt indices on which products are available.
Correct.
Now, how does one choose? I think first and most important thing is, one has to decide what is my investment strategy. Whether I want to invest in large cap, I want to invest in mid cap, I want to invest in small cap, I want to invest in micro cap, or I want to invest in a sector. So you first have to take that call. Once you have decided, let's say you have decided to invest in Nifty 50. Now, ETFs. So how do you choose? Because today, if you look at it, Nifty 50 ETFs also, we have around 18 ETFs available in the market.
Different asset management companies.
Each 18 fund houses have launched ETFs on Nifty 50, which is traded in the market.
Correct.
Now, how do you choose which ETF to buy? There are 18 products now. So there are 3-4 things one has to look at. One is tracking error. I will come to what is tracking error.
Right.
Second is tracking difference, which I believe is the most important thing. Third is, I would say, the expense ratio. Fourth is, what is the AUM? The larger, the better. And fifth, I would say, trading volumes, because trading volumes are also very important. If the trading volumes are low, your impact cost of buying that thing will be very high.
Higher.
Now, what is tracking error? What is tracking difference? So tracking difference is very simple. Tracking difference is the returns given by that particular ETF as compared to the difference in the returns given by the ETF compared to the difference given by the underlying index. So let's say the Nifty 50 has given 10% returns and the ETF is given 9.7%. The tracking error is 0.3%.
So the tracking error and the tracking difference are two different
things. Okay. This is, I'm talking about tracking difference.
Right.
Tracking difference is Nifty 50 is 10%. The ETF is given 9.7. Tracking difference is 0.3%.
0.3%. Okay.
Now, what is tracking error? Tracking error calculates the volatility of this difference.
Okay.
So that is basically, if you look at today, the difference is 0.3, tomorrow could be 0.4. That is the kind of difference. So you calculate the volatility. That volatility is calculated as standard deviation of the difference in returns.
Okay.
So according to me, one should first focus on look at the tracking difference.
So the lower the tracking difference, the better the ETF or the index fund.
The closer the returns will be to the index. So you look at the tracking difference. Then you look at the tracking error, because tracking error will also tell you that how volatile are the difference. So then you look at, but as an investor, I would suggest you focus on tracking difference. Lower is the tracking difference, the better it is.
Okay.
Then you look at the expense ratio, and expense ratio also indirectly gets captured into the tracking difference, because because of expense ratio, the reference going to be different. And then you look at the trading volume, because if trading volumes are not very large, and if you want to go and buy, you want to, let's say, place order for 1,000, 2,000 ETFs of that on Nifty 50, the cost of purchasing might go up. So if the NAV is 550 rupees, you might end up buying at 260 rupees. So look at the trading volumes and the NAV. Sorry, trading volumes and the total amount outstanding. I think these are the basic things one should look at.
So if there was that one key thing that you needed to look at, it would be the tracking difference, because the tracking difference sort of takes care of the tracking error, takes care of the volumes, takes care of the volatility.
That is one. And second thing, if you're especially looking at an ETF, then also look at, is the price quote which is available on the exchange platform or the broker platform, is it close to the INAV, the live NAV or equivalent that point? I think these are the two different ones. Look at, if you do that, then I think you are done. There should not be any problem after that.
So if we wanted to sort of uncomplicate the whole thing, we could just look at the tracking difference and say that this is a better fund than.
I would suggest that. I would suggest that. Look at that and look at the as a price closer to the INAV.
INAV, okay. So the other question that I had was that, in spite of the fact that these passive investment vehicles, ETFs, index funds are very popular in, say, the US, where almost 50% of the total sort of assets under management are under these index funds or ETFs. In India, it is still around 15%. It is much lower than what we see in the US, 16% or whatever that number is. So I mean, if they are such simple vehicles, so easy to track, so easy to invest into, why is it that Indian investors have still preferred active funds to passive funds?
I will not say that. If you look at globally today, especially in the US market, as you correctly said that, December end, the assets under passive was higher than the active.
Right.
I think this is somewhere around 13.3 trillion in passive, and 13.2 trillion in active.
So slightly more than 50%.
Slightly more than 50%. And the last year also, inflows into passive in US has been much more than active. In fact, active saw outflow. Outflow, if I remember the numbers correctly, of almost around 500 billion plus. And inflows into passive would have been around 460, 470. So what is happening in US is, we are seeing an outflow in active and inflows into passive.
Right.
Now, coming to India's story, in fact, I would say we are much behind US in the sense, because the first passive product or ETF in India was launched around 2001. So we are 23 years. And most of the growth, if you look at in the passive, has happened in the last 8-9 years. So I still remember in 2015, June, July 2015, the AUM of passive in India was only 8,000 crore rupees.
Right.
And today, if you look at the AUM of the passive in India, is around 10.7 lakh crores. So I think since then, it has been growing significantly. And one thing is, awareness of the product and the benefits of this product is still not there with the investors. So, but increasingly what we are seeing that a lot of new retail investors are coming into the passive side. If you look at the breakup of ETFs and index funds, so in ETFs, retail investors or HNIs, they account only for 9% of the assets. Whereas in the index funds, retail investors account for 53% of the assets.
Okay.
So most of the retail investors
have moved to passive funds.
Passive through index funds. Right. And what we have seen that the distributors also started selling passive funds as part of your SIPs, etc. And which is also reflected by the fact, if you look at last year into the financial year 24, the inflows into equity index fund was approximately 26,000 crores. And that, I would guess, would be mostly because of retail investors coming in. This year also, if you look at it, approximately 14,000 crores of inflows have happened into equity index funds. Most of that would be because of your retail investors. So what we are seeing, increasingly, retail investors are coming in with awareness going. If you look at media also, earlier no media used to talk about, TV channels or newspapers used to talk about passive, but now everyone has started talking about it. So I think with the increasing awareness, investors will come in. I think we used to be 5-6 years back, 3% of the total mutual fund assets. We have moved to 16%. And if you look at only equity funds, active equity versus active passive, active equity passive will account for almost 22 to 23% of the overall equity AUM of the mutual fund. So equity, the proportion is slightly larger proportion.
So yeah, so what I take away is that investor education, investor awareness is actually improving significantly, and given the simplicity of the product, low cost, if you add on investor awareness, then this can be, a very, very big portion of the market.
Yep.
And then you talked about equity index funds and equity, what do you call it, ETFs, which means that there is a big space for the bond ETFs, right? And not too many people, again, either invest into bond ETFs, and people don't seem to be aware of why they should be investing into a bond ETF. Why is it better than a plain vanilla bond fund, or why is it better than directly investing into a bond fund? So what are the advantages of a bond in the ETF?
So I think, in fact, we take a lot of pride because if you look at today bond or debt ETFs or debt passive,
Right.
the AUM is not small. AUM is around 2 lakh crore plus, 2.2, 2.3
Compared to 10.5 lakh, it is still small.
Equity total is 10.7. Equity would be around 8.1 lakh
Okay.
crores. Debt is around 2.23.
Right.
But if you look at the debt, the entire growth has happened in last 5 years.
Okay.
The first debt product, a lot of us would have heard of Bharat Bond ETF.
Correct.
Was launched in December 2019.
Right.
Which was a very unique product.
Right.
And I will come to that why it is unique product. And since then the AUM just grew.
Right.
So AUM became from almost 0 to 2 lakh crore plus.
Right.
Unfortunately, because of change.
So out of the entire 2.5 lakh crores, 2 lakh crores is in that one single product?
No, there is a mix of, as I said, there are 120 indices on which debt funds are available.
Okay.
So there are lots of products. I will talk about it, more about it. Let me just come. So unfortunately, what happened last year because of change in the taxation on the debt funds, that demand for this product has come down.
Okay.
Now debt, if you look at it in debt ETFs or debt passives, what is the product which is most popular? And we take a lot of pride because we constructed the whole idea, constructed the index. It's called target maturity funds.
Right.
And what is target maturity fund? Target maturity fund is like a normal bond which will expire on a given day. So when you are investing in a target maturity passive product, whether it's ETF or an index fund, so you will know when will the bond mature or that particular index fund or ETF mature. Let's say something called, the first product was Bharat Bond ETF was launched. It was matured in 15th of April 2023.
Okay.
It was a 3-year tenure. So similarly, the other product was 10-year product. So it will mature after 10 years on a given date. So what happened that one is investors know that what is the maturity. It's like any bond or like an FD. Like if you look at Indians especially, we have a lot of affiliation for bank FD because one is we know what is the maturity date. Second is we know what is the
amount you get.
Amount expected returns.
Right.
So target maturity, that's the beauty. One is predictability of returns. The day on which you are investing in that particular fund and whatever is the yield to maturity or the expected interest on that yield to maturity of that bond, if you hold on till maturity, you are expected to get that kind of returns. So that is one. Second is, so far whatever products have been created, the asset quality is very good. Most of the products have been created on either government securities or state development loans or AAA rated corporate bonds. And those are also mostly PSU bonds. As we know, all of them are very safe. So I think that is third. Fourth is liquidity. Because ETFs trade on exchange. Any day if you want to liquidate and you have an emergency funding required, you can sell your ETFs on the stock exchange. Or if you have invested through the index funds, you can redeem it directly with the mutual funds. That is the liquidity. And the fourth pillar was the taxation benefit. When the product was launched, till the taxation benefits were available, a lot of money was coming in. The moment the taxation benefits stopped, then the issuances also stopped. But issuances also stopped because what happened then, because of the interest rate cycle going up, bank FDs started giving good returns. So today, if you look at it, I can put in money for 2 years, 3 years, 7.5, 7.3%, and bonds are giving you 7%. So today, the tilt is towards the bank FDs, but otherwise, this product is very good, ideal for a retail investors. People have been investing in it. I think as the interest rate cycle moves downward and interest rates on the bonds, on the bank FDs come down, I'm sure this product will again, people will start investing in debt products also. But debt is slightly early for the Indian markets. It's a beautiful product which has been constructed, which is ideal for the retail investors because it has got all the characteristics of an FD with a liquidity. You can sell and exit anytime. I think that is what it is, and it will pick up. We are quite hopeful that once the bank FD rates and all come down, this product will also take off.
So the bond ETFs, especially the target maturity funds, sort of solve two problems. They solve the problem of the interest rate risk, and they also solve the problem of the liquidity risk.
Liquidity and credit risk also.
And the credit risk, yes, but the credit risk is anyway inherent, but yes, the credit risk also. So it actually addresses all those three problems which you inherently would face if you put your money into a bond or a bond fund.
Yeah, that is true.
Okay.
That is the beauty of the whole thing, and that is why we saw that a huge demand, huge demand. In 3 years, it mobilized 2 lakh crore plus.
So talking about demand, was most of this demand from the retail individual investors, or was it basically from the institutional investors?
I would say it was mostly, we don't have the data available in public domain, but my guess would be it was mostly from HNIs.
Okay.
And some amount of money going from the retail. If you look at Bharat bond ETFs, because they had done a public issuances and government was supporting it, there's a lot of retail money.
A lot of individuals.
A lot of retail money.
Which brings me to another question, Mukesh. Gold ETFs. Because I do find a lot of investors look at gold ETFs as a very interesting product, and many people have moved out of investing directly into physical gold, and even maybe the gold bonds which are issued from time to time by the Reserve Bank of India, into investing into gold ETFs because of the sheer convenience of it.
Yep.
And how do you see this space in the market?
No, I think this is a very exciting and a good space. Not only gold, actually. Now we have silver ETFs also.
Okay.
So anyone who wants to invest in commodities,
Right.
Earlier we had no option.
Right.
We had to just buy the physical gold or physical silver, which is again a very risky thing.
Right.
Now by investing in gold ETFs, by paying a small amount of fund management fees,
Right.
I am taking the exposure to that particular asset class, which
Right.
is the gold, and I get the returns which are in line with the returns of the markets or the gold
Correct.
prices. So I
Right.
think that is the beauty of it. People are coming in, a lot of retail investors are investing in that particular asset class. We
Right.
have almost, I think, 30,000 crore plus of money available
Okay.
in gold ETFs.
And in silver?
Silver would be 7 to 8,000 crores. I
Okay.
think both put together is around 40,000 crores.
40,000 crores.
And a lot of new folios are there, a lot of retail investors' money are there, trading volumes are also very good. So people are coming into it. People do keep asking, should I invest in gold ETFs or not? I think that's anyone wanting to invest in gold or silver, ETFs or index funds are
Is
there.
an extremely good vehicle.
Extremely good vehicle. And for gold, you also have that sovereign gold bonds which are issued by government
Correct.
of India from time to time.
Right. NSE recently launched, India's first website for passive funds, right? And that's basically to provide, a comprehensive platform for investors to access information, on index funds, etc. So, could you give us a quick guide as to how, investors like us can use that platform?
So basically, thanks for asking that question. So we launched this website called www.indiapassivefunds.com.
Okay.
So our main objective of launching this website was twofold.
And if somebody needed to access it, he could just say NSE platform.
www.indiapassivefunds.com.
IndiaPassiveFunds.com, and he could access the site.
Could access it. So one was, basically today, there is not a single place in India where aggregate passive funds data is available. Like, not many people know that the size of the Indian passive funds is 10.7 lakh crores. There are so many indices on which equity funds are available, so many indices on which the debt funds are available. What are the new products available in the market? What is the new product launch in the last month? What is the trading volume? So we said, why don't we create a website which will make the industry level data available at one place? I think because we as a group, my team, we have been compiling this data for last 7-8 years. We have been doing it in Excel files. We converted that into a quarterly publication called Nifty Passive Insight. We said might as well convert it into a website which will make this data available.
Right.
But the second other thing which excited us, because if you look at a person like me, who's been deeply associated with passive funds, who knows ETFs, index funds very well, but if I want to, let's say, invest in Nifty 50 and if I have to select which ETF or index fund to invest in, data is not readily available.
So the comparative tracking difference, as you talked about, is not available.
Forget about comparison. If I finding a tracking error, tracking difference, expense ratio of any particular fund itself on the fund's website is also very challenging.
Okay.
You really have to hunt, you get it. So what then we said, if person like me or others who are highly aware of this particular segment is finding it difficult to do a comparison and take an investment decision, why don't we make life easy for the investors and give them all this data available in one place, so they can, as I mentioned, some of the parameters like tracking error, tracking difference, trading volume, AUM, expense ratio, why don't we make it available at one place? So that is another thing which is available on our platform. So I think idea was to make the investors' life easy, help them in their investment decisions, and they can take better investment decisions. That is one. And third thing is also we have something called comparison. You can compare 2-3 different funds, plot on charts, and other things you can do. Fourth is we also have a section on resources. If someone wants to learn on passive, what is passive fund, difference between active, passive, or we write, so many indices come in, we also publish research papers on those indices, research notes. You can access those research notes. There will be other educational material available on the website. So we are also trying to see this website can be used by the investors to educate themselves about passive. I think that is the whole incentive, and I'm very happy that the initial response to this website has been very, very positive. People have written to us, and the number of hits also have been very high. So we are very excited about this website, and we would be happy to take more feedback and keep improving the website.
Right. So before we close, Mukesh, I had one last question, right? So if there were two pieces of advice, I purposely am not going to ask you that one piece of advice because I know what that piece of advice will be. But if there were two pieces of advice that you would give an individual investor, what would they be?
My two pieces of advice would be, one is keep life simple.
Right.
Don't complicate your life.
Right.
I'm giving multiple, but that's related to simple. Keep life simple. Don't chase returns, because there are cycles. There is no one strategy which gives you the higher returns year after year. Keep life simple, invest in broader markets, and that I personally believe that you invest in through passive.
Yeah, that was the obvious answer that I was expecting, that invest into passive funds. But the first one about keeping life simple, because if you invest over the long term, say 25 years, as you rightly said, the index anyway gave you a 15% CAGR.
And you see the benefit of compounding. If you are investing in too many funds, and then sometimes one fund will do well, other time other fund will do, you will not know which is doing better, which one to keep, which one not to keep. That's what I said, keep life simple. Follow simple philosophy. Even if you want to invest in active, I said passive, but even if you want to invest in passive, keep life simple. Invest in something which you understand.
Right.
Don't invest in a product which you don't understand, because a lot of time people will come and try to sell you complicated products.
Right.
If you don't understand the products, please don't invest.
Correct.
Soch kar, samajh kar, invest kar.
Right.
That's really my advice.
So that's one of the taglines that you guys quite often use.
You use it.
So this has actually been a very, very fascinating conversation, Mukesh. Thank you for all those valuable insights. So, I mean, I thought we should end this with, a quote from John Bogle, because, if you don't mention Vanguard and you don't talk, I mean, then you're not talked enough about, passive investing. And he said that index funds, eliminate, the risks of individual stocks, of market sectors, of manager selection. So you're only left with the stock market risk, and even that stock market risk over, say, 25 years is not really such a big risk, and therefore, it's a very good idea that, investors who want to participate in this market look at, the passive investing options available, like index funds and ETFs.
No, I think there's one very famous quote by him.
Right.
It says that in long term, for investments in the long term, cost is your enemy.
Right.
And that difference explains the difference between the active fund and the passive fund.
Passive funds, yes.
That's another famous quote of him.
Thank you so much, Mukesh.
Thank you very much, Sashi. It's my pleasure. And thanks for giving me this opportunity to come for this session. Thank you very much.